Measuring risk. Why measuring risk is important. Measuring risk is just as important as measuring returns. You cannot make wise investments without first considering risk. Every investor must be able to identify and understand the types of risk they face across their entire portfolio. Measuring risk shows how diversified a portfolio is. The first thing we need to understand in order to measure the risk of an investment portfolio is to understand the definition of a market portfolio and how they are used. A market portfolio is the portfolio of all risky investments held in proportion to their value. Examples of these market portfolios are a market proxy. This is a portfolio that is constructed so that the return closely tracks the overall market. A market index. It's the market value of a particular broad-based portfolio of securities that represents a segment of the overall market. Two common examples of market indexes are the Dow Jones Industrial Average and the S&P 500. The Dow Jones is familiar to most investors and is an index made up of 30 large U.S. stock companies that represent the different sectors of the stock market. And the S&P 500 has become more familiar in recent years and is an index of the largest 500 U.S. stocks. The value of a market portfolio is calculated by multiplying the number of shares of each stock in the portfolio by the price per share. This is also called the market capitalization, which can also be done for an individual portfolio of investments. The market portfolio is important because it serves as a way of measuring the systematic risk of the market so that we can compare the riskiness of the overall market to an individual security. There are several ways to measure the overall risk of an investment portfolio. Let's take a quick look at a few common measurements that are used in the industry. The investment industry's primary measure of risk is standard deviation. This tells how much an investment will fluctuate from its average return. A portfolio with a standard deviation of 3 means that the monthly return will be 3% lower than its average monthly return, or 3% higher than the monthly return. If the average return is 2%, then the range at 3% deviation would be -1 to 5%. Another way of measuring risk is chance of loss. This measures how often a fund loses money versus makes money. Conservative investments make money 100% of the time and never lose. At the other extreme, some Far East funds lose money as much as 60% of the time and make money only 40% of the time. Another way of measuring portfolio risk is magnitude of loss. This is when an investment loses money, how much could a fund lose in any given year? Measuring this will tell us the tolerance we have for loss. Another measure is drawdown. Drawdown is a loss that occurs from a portfolio's high point until it begins to recover that value lost. Drawdowns are typically expressed as a percentage from a previous high. Although there are many more complex measurements applied to calculate risk in the industry, the majority of them require understanding beta ratios. In order to measure the overall risk, we need to understand how beta is used. We can then see whether or not a stock's returns are closely related to the overall market, making it sensitive to systematic risk or volatile. To do this, we look at an individual stock's beta. Beta is the expected percentage change in the excess return of a security for a 1% change in the excess return of the market or other benchmark portfolio. The beta of the overall market portfolio is 1. A stock with a beta of 0.5 is half as risky as the overall market. A stock with a beta of 1.5 is 50% more risky than the overall market. Although the evaluation of risk of an investment is the most common factor that is considered when choosing an investment, it shouldn't be the only factor. Those of us who adhere to Christian values should apply those values to the investments and companies we invest in for both our business and personal investments. From the Bible, we're told, whatever you do, in word or deed, do everything in the name of the Lord Jesus, giving thanks to God the Father through him. Everything has no exclusions. Therefore, as Christians, we should be mindful to invest in companies that are also ethical and do not win at someone else's expense. We should invest in companies that are environmentally responsible. We should invest in companies that do not profit from medical procedures that go against our beliefs. And we should avoid investments that are considered sin industries, like pornography and tobacco companies, are companies that knowingly participate in deceptive marketing.